This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thank you for joining us. My name is Bruce Norris, and once again, we are joined by Jordan Levine. Jordan, welcome back.
Hey, thanks so much for having me back. You know, I think that it's absolutely a valid point, and that's, you know, I'm definitely in a kind of cautiously optimistic camp. I think things will continue to get better, but I think that we've got a lot of healing left to do. And I think that in a lot of ways, we have kind of kicked the can down the road on really grappling with some of the most challenging issues left to be dealt with, even as the public health thing starts to abate and we get, you know, widespread distribution of the vaccines and we can kind of have more normal economic activity out there. We've got, you know, again, a long road to hoe on that. And I think, you know, when you look at the continuing claims here in California alone, you know, you're talking about 2.6, 2.7 million people once you throw in all the pandemic claims and the regular extended unemployment insurance, the regular unemployment insurance. And yeah, it's not the 6 or 7 million that we had back at the peak, but, you know, we're still talking about 6, 7, 8 times more than the kind of previous concurrent maximum number of folks who were on the government payroll at any one point in time. We've still got a lot of you know, folks are in forbearance or you can't be evicted right now. And I think we've learned a lot of lessons from last time, right? It looks like there's going to be payment plans. We're not just going to do like big, you know, 12-month balloon payments at the end of this. That's going to, you know, get people out of their home, but they're still on the hook for that money, right? And so even as you maybe get your job back, your income starts growing, part of you know, your economic recovery is going to be dedicated towards digging yourself out of that hole that you've been in, right? Because that doesn't just get excused or go away. And that's going to limit, even as things get better, we're not just going to be able to all of a sudden go out and buy that boat that we want and do all that kind of stuff. And so I think that, you know, we've got a long way to go and still a lot of pain out there. We talk about the K-shaped recovery, right? Some of us spreadsheet nerds can still do our jobs on the computer, but other folks have had, you know, real significant impacts out there that they're going to take a long time to recover from.
You know, it's been a little bit different experience living in Florida because of, I'll go visit California and there'll just be different things locked down. I have somebody that owns a karate dojo that hasn't been open. It's been closed for, you know, several times. Yeah. And he's pretty established, but, you know, that takes its toll. It's next to a restaurant that's closed and it's, you know, on and on next to a theater that's closed. And I get a feeling in my gut that this unemployment number is somehow calculating things that, not calculating those people because I'm not sure. What are they? They were self-employed, so they're not looking for a job. Does that mean they don't get counted? That type of thing.
Yeah, definitely. I think there's statistical anomalies there. And I think that's why it's important to triangulate and never hang your hat on one indicator. And I think when you look at the unemployment rate, which continued to go down, if you look at the California number, it dropped because people got discouraged, right? And so you can always it's easy to be fooled by a falling unemployment rate because it can go down for good reasons or it can go down for bad reasons. And I think that is also, you know, taken together with just how many people are actually on the government payroll, and you still have folks out there who are trying to find work and can't. It speaks to just, you know, how much, you know, how far the road ahead is, and it's still fraught. And I think, you know, it's probably going to get a little worse before it starts to get better, you know, until the public health thing is really clearly in the rearview mirror.
Yeah, there's a fear that, you know, some high percentage of restaurants, for instance, are just not going to reopen. They'll just go try to work at another restaurant, that type of thing. I have a great friend who's been in the travel business. He's a sole proprietor, works alone, and he, you know, books cruises of all things. Yeah. So, you know, every cruise he wrote for 2020 got canceled. Right. Every cruise that he booked for 2021 has been downsized. It's no longer 3 weeks, it's a week. Yeah. And that's been a catastrophe for him. So anybody in some of those isolated industries, it's really been really challenging. And I'm not sure is reflected in the stability of that unemployment number.
Yeah,
So,
definitely. You know, and I think we'll see that eventually trickle through to housing. We're not seeing people, you know, right now, and luckily we have such a strong demand environment that you're not seeing a lot of people have to walk away. There's home equity, and I think the fundamentals are different than last time. But I think there's, you know, going to be folks who aren't able to hang on, and it's really, you know, just a testament to how severe this crisis really was. That even as, you know, an environment where prices are going up and people want, you know, are fighting over few homes and things like that, that you're, you know, you're going to have folks who aren't going to make it.
um, foreclosure levels to me are a big deal because when I look at charts, you know, trying to figure this stuff out as an investor, say
Yeah.
what's the domino, what's the first chart that goes and all these other go. And what's really interesting is like in 1980, for instance, 80, 81, 82, we had 17.5% interest rate,
Right.
at least one point in there because I refied my house at that.
Yeah.
So I become an investor. We had about 10.5% unemployment. You give those two figures out and then say, okay, well, what was the price damage to the median price of real estate? And it was nothing.
Right.
Now that's really weird. And I mean, so I'm trying to figure that out. How does that work? And I took a look at the ratio of foreclosures in the marketplace, and it was 25% foreclosures, 75% regular sales, in a way that lended credibility to me because I thought, okay, if you're an appraiser, you could ignore that one sale because that's not the market.
Right.
In 1990, it became 40% of the market. In 2008, it was 80% of the market. It
Yeah.
was the market.
Yep.
So that's kind of my question is, do you see the lenders kind of anxious to foreclose, or do you think they're going to go, we just recently learned a lesson and we are not going to pull the plug hard and fast on that?
Yeah, I don't see the banks in a rush to do that. And I think, you know, it's interesting if you look at the CoreLogic numbers, they do a good job of tracking delinquencies and especially all these COVID related forbearances. And I think, you know, to borrow a phrase from my daughter's favorite song, the bones were good coming into this one, a little bit more so than last time. We didn't have all the 5-1 option arms. I think, you know, if you
Right.
go back to 2005, 6, half the market, half the mortgages we were originating were adjustable rate, where we had people even like picking their own payment. They weren't looking at amortization tables and realizing like, oh shoot, this mortgage is going to go up by $2,000 a month here starting in, you know, that just wasn't a thing this time around. We didn't have the liquidation of home equity. You know, the cash out refi numbers, the once you strip away just like second consolidations, right? But true cashing out was much more modest, even though the underlying values of these homes are much higher today than they were even at the height of the last bubble. That we're talking about a fraction of the cashing out. So you didn't have this whole kind of my house is my bank account, let's all go to Europe kind of thing this time around. And so I think that is critically important. And you see that. So in those CoreLogic numbers that I mentioned, when she looks at the COVID forbearances, I think she said Selma Hepp at a conference that we had said 2 out of 5 COVID forbearances had already exited. Part of that was because they were performing. I think like 7 out of 10 of those were reperforming again because people got their jobs back or whatever. But about 15% were people who paid off the mortgage in full. And that is something that you didn't have the option to do last time, right? Where Lehman Brothers crashed. We had all these you know, fundamental imbalances with the ninja loans, with the option arms and all of that stuff. And so all it took was an economic nudge to really get that snowball rolling. This is an unprecedented shock, but again, it's one that's happening to an economy where we had really stringent underwriting, right? Where you had to put
Right.
skin in the game. These are all people who got fixed rate mortgages at 720
Exactly.
FICO scores and higher, and kept their home equity in there, right? And so even if you do lose your job, you don't throw the keys to the bank on a home that you have equity in where there's a line of buyers going around the block who want to take that off your hands. And so that's
That's
not to
right.
say that everyone's going to hold on, but I think way more people are going to be able to hold on than before.
Yeah, what you said is really important because if that foreclosure even occurs, it probably gets bought by a cash buyer
Right.
or now by the state of California. So the odds of that becoming inventory in the MLS that damages the comps for normal sales is not going to be a big percentage, I don't think, for sure.
Yeah. And I think, you know, the share of foreclosures determines the discount of foreclosures, right? Because if you're one random foreclosure in a sea of, the consumer doesn't care. To the consumer, it's a house. They want the house. And so unless you have it totally dominating the market, the price impacts are going to be minimal.
Yes, that's right. What was scary about 2008 and 9, it being in the rehab and the resale business, the appraisals wouldn't come in on a ridiculous resale. So we, like a 360 house we bought for 64 grand.
Yeah.
Fixed it with 20 grand, had it for sale for 125. Had
Yeah.
like 20 offers in 2 days and it appraised for 95.
Yeah.
Because the only comps were vacant houses that were REOs.
Exactly.
And you're just going, wow, it's such a dominant player, but I don't see that either. There's a lot of people waiting for foreclosures. And I know that there's even Wall Street firms that are setting up funds to buy and lease back to the owners, interestingly enough.
Yeah.
Okay. If you're doing research, what charts would lead you to believe that a particular state was in for some serious economic growth?
I'd look at the in-migration, every, people can laugh all the way to the bank at California's inability to get its housing situation sorted out, because I think you look at people who move, and actually I think it's Ellie Mae has a really good millennial tracker, right? So they can see where the millennial mortgages are being originated. And I think that's monthly and it's free and you can just go online and check it out. But I think that subset in particular of out migrants, right? Those young, skilled college graduates who have the skills all the employers want and all that stuff. You see where those guys are going, and those girls, that's where those are the folks that the companies want. And so that's where, that's where they're going to follow. I think that they, in some ways, the tail wags the dog on that front, right? They go where the workers are.
Some talk with the new Biden administration to do some discounting of college debt, debt forgiveness of 10 grand to 50 grand. What's the impact you think for housing on that one?
I think it will definitely help. It's a shame it wasn't around when I was buying a house, but I think that the correlations between student loan debt and home ownership have been documented, not just by trade groups, but also in the academic literature, that that detracts from your ability to spend money elsewhere. One of those elsewheres is ownership housing, and so I think that the ability to get that leg on the property ladder has been impeded significantly through a whole host of things. And so anything that helps people get that first home that's what unlocks, wealth accumulation and things like that. I think that there's, if you want to help housing out and that's the goal, I think there's, ways to do that more directly by like building more housing and giving people help to actually buy housing. But I think that there are linkages there between college debt and housing.
Jordan,
go ahead.
One of the biggest concerns that investors are having with us is the 1031 exchange. Do you have any thoughts on if that really could go away or parts of it?
That's not been flagged for me as an area that we're, more concerned about. I think that, we've been really focused on the GSEs up till this point. And I think that, that will probably dial back as a source of concern going forward. But I think that, one of the things, and we kind of joked about it before, but where I think we get more bang for the buck is on, assumable loans, because I think that, there's going to be a really nasty byproduct of everybody having 2.6% mortgages one day when rates go up. And so I think that, 1031 exchange is a big thing, but I don't think that's a big policy emergency or a big target. I don't see that as having a huge target on its back relative to some of the other housing policy things that are in the mix. I could be wrong on that, but that's my read.
So if that's not a big target, what's the biggest target that you guys have?
So I think we're trying to be proactive on the policy front. I think that we're trying to look at ways that we can be, offer up solutions, right, and be in the affirmative. And so looking at commercial conversions, I think is a big opportunity. I think assumable loans. I think low rates are going to be like the Prop 13 of the future, right? Where why am I going to ever leave this house even if I hate walking up and down these stairs? I got a 2.6% mortgage, right? And I'm not going anywhere. I always joke because my dad was one of those guys like Bruce who had that 13% mortgage back in the 80s. And he was always like bragging about it because his buddies had like, 16% mortgage. So yeah, I think, the commercial conversions, I think the assumable loans, all that stuff, I think GSE and making sure there's still, support for home ownership in terms of mortgage finance is critically important. I think finding a mechanism for ADU finance that's more, broadly available and workable, right? Because I think that's a huge key to unlocking wealth and housing supply and solving, a bunch of our problems in one shot. But there's no like financing mechanism, right? So unless you want to get some kind of a non-traditional construction loan, or you got another home that you already own with home equity that you can access or something like that, that's a piece of the puzzle that we could really light up, right? It's a good investment. The banks would like it, right? We just need to like formalize a kind of mechanism for that stuff. So I think that there's all kinds of ways that we can get creative about like not being against stuff and be for stuff that actually is like a win-win for consumers, for income, for wealth accumulation, realtors, everybody.
Comps has been the issue there, right?
It's been tossed about a $15,000 house buying credit.
Mhm.
So that's an interesting thing, but I'll run this by you because I've talked about this a few times.
Sure.
Rather than a $15,000 credit, and why not have a nothing down loan program that has its own set of rules? Here's the set of rules. You'd have to qualify like a veteran, like a VA loan. So they have VA loans, very successful. They have to have some cash flow in place, and they have to have maybe some equity somewhere, but they have a very successful loan program without a down payment. The loan program would be completely assumable like a subject to loan. In other words, you don't have to qualify. You have to make it current if there's a default. And just for this loan program, you have one foreclosure law, not 50. And the foreclosure law is on the anniversary of 6 months of non-payment, the opening bid is a late payment, not having anything to do with the principal. You just sell the late payments to somebody, give it a priority to the owner occupant. What I think that would do is I think it would change home ownership through the roof, but I also think it would also do its share of reaching across the aisle to the have-nots.
Yeah.
And say, you get to own a home, man. You get to have a mortgage rate at 2.5%. You're going to save probably $500 a month and own something. I remember the day I first owned a house. It was emotional.
Sure.
I was like 22 years old, and I remember mowing my lawn thinking, my God, I've arrived. I'm a man. It's so weird. I really felt like that.
Yeah.
I didn't have a dime worth of equity. My windows didn't open, but my name was on a grant deed, and it changed my entire life. I think if we want to reach across the aisle and say, you know what, this is all you have to do, make a payment on a 2.5% mortgage rate, and say 15 grand a house.
Yeah.
And whatever default you'd have, let's be outrageous and say you have 20% default, which would never happen. You do the foreclosure process, like I just said, you'll have no REOs. It'd just go to somebody else.
Well, I'm a big fan of home ownership. That's why, I was kind of glad to hear that you said I lit up when I was talking real estate. I believe in this stuff. That's why I'm here today. My dad didn't even graduate high school. He was from San Diego, or he's from New Jersey, and then moved to San Diego and didn't even make it through high school. He worked at the parts department, but he, bought his own home in the late 70s and hung on to it through thick and thin and all that stuff. And, that just, that is the real American dream. That's why I was able to, he didn't have fancy, economist friends, or his buddies were like professors at USD or something like that. He just had owned his own home. It provided the wealth accumulation, the stability, where I just went to school and focused on getting good grades and can like be here, nerding out on housing stuff today. And that is what we want more folks to be able to do. I think that's the one. If you go look at the Fed's numbers on consumer finances, right, that's the one tried and true way that people accumulate wealth. If you look at the wealth distribution, right, it's all owned by people who own their own home. So it's not a secret.
Absolutely.
That's how guys like my dad did it.
Yeah, and to share that with people that have, don't have a down payment, but the willingness to make the payment, I think it would be a really smart move, because then what happened is you do end up, you have a mortgage that starts to gradually pay down. You get a little bit of equity, you become entrepreneurial, you get a credit line, you go get another house, or you go start a business, and all of a sudden you're very independently capable of taking care of your family.
Yeah.
That was a big deal, bigger picture stuff I want to just cover we got maybe 9 more minutes.
Sure.
A lot of things floating around. So I don't know how much the debt grew this year, 3 trillion or so,
Yeah.
give or take
Yeah.
$1 trillion. And
Yeah.
next year, maybe what, 3 to 4?
Probably.
At what point, we hear the inflation word. What point do you think that's a concern?
Yeah, I mean, if you go back to Econ 101 at UC Santa Barbara that I took way back when, they that would tell you that eventually the bond market's going to come for its pound of flesh, right? For all these evil ways that we've been doing. But I think that there's a kind of there's a global financial component to the bond market as well. And I think that, we always joke that as many warts as we have, we're still kind of like the cleanest dirty shirt in the hamper kind of thing. We still got a few more days left in us compared to the rest of the global financial system. And I think that until, there's fundamental changes to we're still the backstop. We're still the global reserve currency. The contracts are written in dollars and all of that stuff. And so until we start buying oil in yuan or Brazilian peso or something, that I think that we're still a safe haven, right? Betting on the US government to still be in business, that's what fuels a lot of this bond buying from the rest of the world, right? They're not trying to get big returns on a 10-year treasury. They're trying to protect against their own currency tanking. And so I think that is still very much a phenomenon. That's why we see low rates even when we're running up the credit card. And so I think that we do have to get our house in order. I'm not as worried about putting stuff on the credit card right now when we're at 10 or 15% unemployment. That's when you should be using the credit card. What I worry about is that we weren't getting our house in order before then, and probably won't do it once we're back to doing well economically. But I think that it would take big changes for us to see, and there's been such a decoupling between the labor markets and inflation as well, right? You just don't see a lot of upward wage pressure driving inflation. So I'd be surprised if we saw near-term inflation that's anything to worry about.
Bruce, can I ask one last question?
Go ahead.
So with this election, I got a question about the election. Okay, so not big overall, but I want to ask a question on: was this election a win or a loss for California real estate? And then my second part of the question is, can you talk about Prop 19 and how that's going to affect California real estate?
Yeah, definitely. I mean, our view on the elections are that they don't have a big effect on the day-to-day operation of housing. If you go back and build like a statistical model and try and do econometrics on this, once you control for what's happening with jobs and interest rates and people's incomes and things like that, you just don't get a lot of significance. We did it 6 ways from Sunday, whether it was incumbent or not, party affiliation, first timers going up for it. I mean, there's just it's driven by those kind of dinner table issues, right? Did we have babies? Did we get divorced? All those life change things. And then the kind of macro environment. I think, you could argue for things like the impacts on GSE, but it's really just a policy thing. And so I think that very much the housing market here is more dominated by the supply and demand stuff that's set at the household level. Prop 19, I'm optimistic because we've taken away some of the penalty that long-term homeowners had for potentially wanting to downsize. You got guys like my father-in-law who live in a 2-story house with a pool that was good for, somebody who had 3 teenage kids living in the house, but doesn't work anymore. But, he doesn't want to give up face that huge tax of getting increased property taxes. But the thing that has me more optimistic is not just to get folks like that motivated to move, but hopefully what it does is it motivates builders to build some of the product that guys like my father-in-law maybe want to go out there and buy. Because I think that's the flip side of the coin, right? Is that you take away the penalty, and that's one thing, but I still got to have a house that I actually want to move to. And so hopefully that catalyzes some new production. One of my favorite economists over at USC, Richard Green, says California never builds affordable housing. They build new housing. And so, if we build new housing and let those long-term homeowners move into that, the housing that is affordable is the old housing. And there's lots of families out there who would, kill to get into those 1970, 80, 90s built homes that those people would be opening up. So
well, you talked about earlier, you put an ADU in the back and then just rent the front.
That's right. Yeah, exactly. We get the financing going for that. That's the double whammy. So
I want to wrap up talking about, we talked about inflation. Is there anything that you look at and say, wow, that's deflationary? And that's an issue.
I think this, I think this high unemployment, I think the Fed's done a good job through this crisis, honestly. And I think backstopping the economy, because I think the high unemployment, the falling economy, the closure of all these businesses, that's the biggest deflationary thing. You got a lot of desperate people out there. You start to see a lot of downward pressure on that wage side of the equation. And so, I think that the sooner, that's why, again, I'm not as worried about the budget stuff right now, right? Because I think the more we can help buttress demand over the short run, then you kind of give it some foundation to grow from, and then we can worry about paying down the credit card once things, get better. But I think in terms of housing demand in particular, and I think housing is also just that safe haven in the same way that a U.S. government bond is. So to the extent that you're still worried about unemployment in the stock market and all that stuff, I think that the housing price in particular should be pretty stable.
Do you, taking a look at AI or robotics, demographics, do you view those as dangerously deflationary or quite manageable for the United States?
Over the long term, I think that we've really got to do some soul searching in terms of the structure of our economy, right? And look at ways that we could talk about sharing the gains from some of that stuff, right? And I don't know what the right answer is, but I mean, there's, it's not just the jobs, and there's, a lot of good books about this out there, but I think that there's a lot of jobs that can be automated. Contract law, lawyers, right? It's not just hammer and nail stuff. And so I think that it will have profound impacts that we need to plan for over the long run. Just those are kind of 10+ year issues, but very much, I think, ones that we should be thinking about right now.
Okay. Well, Jordan, I've had a ball. I knew I would.
Hey, Bruce, it was fun.
That was really nice to bat it around with you. And you can check out CAR's website, www.car.org, and it's got tons of information, not only up to date, but also historical if you want to create a chart and get nerdy.
That's right. So
okay.
Thanks again.
All right, Jordan. Enjoyed it very much.
We'll see you on the next one.
Okay.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.